Hi traders, welcome to Market Outlook Trends, Risk Events and Trade Setups brought to you by Vantage Markets. This is a weekly webinar where we focus on what's been happening in markets and what is about to happen in the week ahead. Whilst I just let you have a quick look at the disclaimer, I'll just run through what we hope to get through in the next 30 minutes or so. Firstly, we'll just check out how markets are trading currently. We'll obviously address the key theme of the day, which is trade and the deadline that President Trump has imposed on trading partners July the 9th. So we'll look at some thoughts around that, which is really quite uncertain at the moment. So yeah, a few thoughts around that. We'll then just have a chart with US stocks against European stocks. And we'll look at stocks and technicals around some of the main indices. After that, we'll just check out the main risk events from the last few days. So non-farm payroll, of course, we'll go into that in some detail. We'll also look at some of the other US data, the ISM data, before then looking at Eurozone inflation data out last week. And then we'll look at this week's main calendar events, of course, two central bank meetings, the Antipodean, so the RBA and the RBNZ. And we'll briefly look as well at UK GDP data and Canada jobs, and all the while looking at all the associated currency pairs. Okay. So first up really is how markets are shaping up. Of course, this morning, definitely trying to cope really, investors, traders, markets with these multiple layers of uncertainty really, as the US will move to the next phase in imposing trade tariffs. President Trump at the moment, or the latest news is he's sending letters to about 12 or so countries, informing them on the higher tariffs they will face. That said, US Treasury Secretary Bessent indicated that these tariffs will start on August 1st, providing some space for trading partners to do concessions. And then at the same time, the US still also intends to announce some finalized framework trade agreements. This setup in a first instance basically leaves markets with plenty of uncertainty and also questions. We try to think around these. Will August the 1st become a next informal deadline? Which countries will get higher tariffs? Will they, in some cases, of course, even go higher than the top tariffs announced on April 2nd? And even this morning, President Trump, he's added a new layer of uncertainty, really, as he's threatened countries aligning with anti-American policies of BRICS with an additional 10%. However, the US president didn't specify what this alignment exactly contains, and one really assumes, I guess, a series of unexpected plot twists over the coming days, hours, which are really very difficult to anticipate. That's what we're facing in the next few days, certainly. And markets really have started off the week somewhere between sort of paralysis, if you like, and guarded risk off. Most Asian equities, they traded modestly lower. US stock futures, they are modestly lower as well. US Treasuries rose actually, so the yields have been declining modestly. And even after last week's payrolls, US payrolls, which that we'll get into, markets are still pondering actually the chances of a restart of the Fed easing cycle if the US data were to weaken later this year. The dollar, that's marginally gaining. You kind of think the currencies of countries that face higher tariffs might be vulnerable in a first stage. But then again, even so, the post sort of April 2nd experience, if you have that in mind, we kind of assume that a broad-based dollar rebound will be difficult in the context, of course, overall of US-induced trade protectionism. Also, we think it's worth bearing in mind just a couple of other thoughts post that April 2nd, or since April, really. And that's just around, volatility has fallen actually as President Trump has really shown themselves to be more interested in cutting deals than pursuing tariffs for ideological goals. That we think is a really important issue just to bear in mind. And then regarding trade deals at the moment we only have kind of the UK and Vietnam. We have a truce with China. And for the rest, it's a question really of whether last minute deals are struck, whether tariffs have substantially increased, or whether fresh extensions are announced. That's kind of what we've just been talking about. All seem possible. Probably the most focus this week will be on the major trading blocks, of course, so such as the EU and Asia, where most of the US trade imbalances really stem from. Also, I guess threats of a resumption of 50% tariffs could briefly hit the kind of benign risk environment that we are seeing. Although, with a market already positioned underweight the dollar, let's not forget that, then possibly it doesn't have too far to fall. So much uncertainty, really, all dependent on what President Trump is going to do. Tough to call, as we've said on a number of occasions. As for stocks, I'll just show you a chart that we just pulled up. Interesting, 2025 was, well, meant to be European markets year, really, as erratic sort of US policy making. And then we've also seen that once in a generation fiscal shift in Germany potentially was going to prompt, obviously, investors to shift their money into Europe. That's still the case, of course, for the euro, but in equity land, well, Wall Street has been catching up fast. And you can see that from this chart. The stock 600 benchmark European index, that's up 6.9% or so this year. That's just 1 percentage point above the S&P now. And that's a narrowing from this gap from around a 10 percentage point gap in March around here. So a storming few months for the US, really. And really, it's all about big tech again. Europe can't compete in that space, really, and that's driving a lot of US performance. If you think of poster child Nvidia, that hit a market value actually of $3.9 trillion on Thursday alone. So Mag 7, big tech, mega cap top tech stocks really driving the S&P 500, the broader index, higher with its high percentage weight or with its high percentage of weighting in that, of course, benchmark index. Again, we talked about this rally being more broad-based, and we saw last week, actually, we related to industrials climbing over 12% year-to-date, communication services over 11, utilities over 9, financials up around 8%. So all outperforming, so kind of giving you a picture that it's a more broad-based rally, but ultimately, of course, those mega cap tech stocks are still driving the gains higher on the S&P. Of course, then just wrapping this kind of idea up, US friendly or Europe unfriendly tariff developments, they are potentially coming in the few days ahead, in the few weeks ahead. And then that could see possibly then Wall Street overtake Europe on a year-to-date basis. And just remember all the pessimism sort of start of April around US stocks, around selling America, selling the US. Generally, of course, that's happened in the dollar for various reasons, as we've mentioned, talked about previously. But then, of course, stocks are a different ballgame. And just on those sort of few factors fueling this rally in the S&P, aside from mega cap tech, of course, and AI reigniting really risk appetite in US stocks, we've had geopolitical relief, of course, from the Middle East, really, trade optimism kind of has returned, although obviously we're getting into that uncertainty this week. And then we've had US economy pretty much holding up, and we're getting to the non-farm payroll report, of course. And then we've also had this policy relief, if you like. Fed cut rate expectations did ratchet higher. They've kind of pulled back since the NFP, but still there's a couple of 25 basis point rate cuts presumed by the Fed going to happen this year, and that has obviously then fueled risk sentiment and this rally that we have seen over the last few months. Going forward, I guess we again talked about this last week. Of course, we had the tax bill, which President Trump said would be signed by the July the 4th and was done so. Trade deals, of course, we talked about, and then we have Q2 earnings season coming up. An interesting expected just a 2.6 year-on-year EPS in Q2 25, so much lower than the above 15% EPS we saw in Q1. Of course, then just be mindful of geopolitics. And then as well, there are other issues like Fed independence, of course, hits the dollar more than stocks, but just to be mindful of. And then tax cuts, potentially deregulation, as well as, of course, monitoring data going forward. We also had this chart actually recently, and I've kept it in here just to show you, obviously, the dollar free fall that we've seen and that dollar selling that has obviously been going on recently with euro sterling hitting multi-year highs against the dollar, and really investors looking at moving some of their weighting of dollars into liquid other currencies, the major one being, of course, the euro. Okay, let's move on from this to last week's main event, and that was non-farm payroll data and other bits of data as well. Here we've just got a graphic. We had the preview last week, and we've got the review, if you like, this week. So hope you like sort of the main figures that have come out of the NFP. Job growth, just in summary, and the unemployment rate came in better than expected, 147 against 106, that headline, 16,000 of revisions to the past 2 months, just for your guide. The 3-month change, well, the 3-month average actually was 135, I think. It's now around 150, so pretty much on the button now. And that's consistent with balance between labour demand and supply. The jobless rate, quite surprisingly, actually fell to 4.1 from 4.2. Market forecast 4.3. But it's interesting, actually, the better prints were not for reasons tied to a strong economy per se. So local and state government jobs contributed half of the net growth, while people dropping out of the labour market resulted in that lower unemployment rate. So interesting detail there. And even if you go into more detail around the jobs, government and leisure and health, plus private education and healthcare, they contributed 87% of all jobs added now in the past 2.5 years. And those are sectors not traditionally associated, as I've said, with a strong economy. And also, if you think going forward, those sectors will again be hit or impacted, at least going forward. So government jobs potentially hit by Doge, healthcare by the one big beautiful bill, and then hospitality and leisure probably will be impacted by the more cautious consumer potentially, although obviously we had relatively decent jobs market still ongoing. Also leading indicators we would point out like business surveys, plus also upward momentum that we have seen in the weekly initial jobless claims data that could potentially point all to more layoffs from later in the summer. Of course, though, that headline print, as we've said, that certainly wrong-footed a more softly positioned market, if you like, going into the data. For the Fed, then, most Fed members, FOMC members, of course, are relatively cautious. They're wanting to see, of course, what the tariff impact on inflation will be before acting in response to potential labour market weakness. That was a tone really adopted by Jerome Powell in his appearances last week, or the prior week, sorry, before Congress. He basically stated we're well positioned to wait to learn more about the likely course of the economy before considering any adjustments to our policy stance. Of course, there's uncertainty over inflation, but the Fed would likely need to see clear evidence of softness in the form of subdued payroll growth and rising unemployment to trigger an early move. And we're not seeing that at all. And we would need to see that probably over a number of reports. And certainly we haven't had that yet. And that's what we've seen in market pricing for the Fed, basically. It was around a 1 in 5 chance of a July cut before this data. Excuse me, 20% chance. That's now virtually nothing. So zero chance pretty much of a July Fed rate cut. And then you can just see there was around 65, probably a touch higher, 65 basis points priced in for the whole of the year before this data release. Now it's back down to sort of 50, around that number. I haven't checked very recently, but around 51 basis points after the report, after the NFP data. So reduction in the number of rate cuts seen, really, that pricing, and just over then, that is 225 basis point cuts, as I said, for the whole of this year. So that's the NFP. We did have Chair Powell speak actually at the ECB Sintra conference last week as well. I kind of reiterated what he said before Congress, but essentially the Fed in wait and see mode with monetary policy. US economy still relatively in robust health, and of course those inflationary impacts of tariffs yet to be seen. I'll move on then to, well, I've got a chart here actually from one of the investment banks just showing you that 3-month average kind of ticking up now up to sort of around, where was it, 140, well, around 150,000 now, that 3-month average for the headline. And you can just see the payroll change there around sort of decent number, 150 or so over the last few months. We also had ISM data, as I mentioned, US ISM data. Manufacturing that rose, but still remains below 50, so in contractionary territory. And then non-manufacturing ISM, the services, that marginally topped consensus estimates actually as well, and kept, the headline rose to above 50, actually, from 49.9 to 50.8, so above the 50.5 expected, mainly thanks to a rebound in new orders. Just for your guide, though, on both these ISM surveys, actually, they continue to point, and I've mentioned this, these surveys continue to point to downside risk for the US jobs market through the remainder of the year. So the manufacturing employment index, that fell back near to its recent lows, 45.0 that was. And then the ISM services employment index, that was well below its 5-year average of 47.2 in June. So just something to note, this has been cited before as a reason for the jobs market weakening, but we haven't seen that as yet. So yeah, something to be mindful of going forward. Okay, I'm just going to pull up first of all. Sorry, I didn't look at. First of all, I'm just going to pull up euro dollar chart actually, because we're just going to Eurozone inflation. Yes, just quickly, and you can see here euro dollar chart. Eurozone inflation, that came out last week. The headline ticked up actually to 2% on higher energy prices, but core remains stable at 2.3%. Services inflation, that barely experienced any bounce back up after the unusually low reading in May, ticking 1/10 higher only to 3.3%. So overall in the Eurozone, domestic inflation kind of expected to stay benign going forward. Inflationary pressures have clearly weakened as wage growth is coming down. And that should then trend to around 3% at the end of the year, which is basically consistent with inflation at the ECB's 2% target. Economic performance, though, does remain sluggish, and that potentially keeps the door open to another rate cut later on, probably in autumn. I think the first cut is priced in December. So, nothing to write home about really with that Eurozone inflation data, but the headline, continues to probably tick around that 2% target going forward. For the euro dollar, well, you can see the really strong uptrend, bullish momentum that we've seen. We're just pulling back now, which is interesting. And if I pull this back, let me pull up the weekly actually. So this is euro dollar weekly chart from that high in, well, 2021 at 123.51. Went down, goes down to the low from September 2022, and you can just see there is a Fibonacci level around 117.49, if that's valid or not. Then the next major one actually capped the upside a couple of times. That's at 112.76, but there's a 78.6 fib level at 117.49, and we're just sort of oscillating around that. I'll just pull up the daily. You can just see possibly if we do lose that, then we do have some swing highs at 116.31, and then this notable one from April at 115.72. So that's euro dollar. If we just move on, then just bear with me 1 second. So we just got a question here, which is great and really appreciate. And I should have said at the start of the webinar, if you do have any questions, please do write them in the box, and somebody has. So just bear with me 1 second. I just want to check out this question. So if price hits a 20-day moving average on a smaller time frame, is that a signal for a buy? Interesting question. Thank you very much. Let me think about this. If price hits 20 period moving average, well, because we're talking about different time frames here, not just 20-day moving average, it would be whatever time frame you're looking at. So if you're looking at, say, a 4-hour chart, that would be the 20 period moving average of that time period. Same if we were looking at a weekly chart, it would be a 20-week moving average on that time frame. So if price hits a 20 period moving average on a smaller time frame, is that a signal for a buy? Potentially it is, but what I would say is that really I myself, and I know many people recommend using various different indicators and then to determine if it's a buy or, of course, if it's a sell. If the moving average is moving up, then I would look at probably other momentum indicators as well. I would look at, say, the RSI potentially. I would look at a different time frame, as you've said. But various indicators I would look at then to confirm whether I've got a definitive signal, if you like, to buy. I hope that makes sense. And it really depends on, yes, other indicators that I'm looking at to then signal whether that is a buy. So it could potentially be a buy with that question, but I again would probably look at, as I say, possibly other moving averages, but possibly other momentum indicators as well to confirm that signal for sure. Also, then, you know, and I've done a lot of, or I've got a lot of experience really, and that's then. I refer back to that when back testing, basically, before then trying to determine whether that indicator is a good buy signal or sell signal. So I would check how that works in other sort of similar price periods of price action, and then have more confidence that it would be that buy signal that we're referring to. Hopefully that's answered your question, but please do ask any questions along the way. As well. Okay, let's move on then to this week's main events. And let me just pull up a couple of charts. Well, this week's main events, sorry, being a couple of central bank meetings and a couple of bits of data. It's a quieter week for US data, but firstly we get into the RBA meeting. That's out overnight tonight, really UK time, Tuesday morning, Asian time, of course. And just bear with me. So if I pull up an Aussie chart, It's still, I'm just still thinking about the question, actually, to be honest. Here's the Aussie dollar chart. So here we've got a daily chart. You've got the blue line, which is the 50-day moving average, moving up through the black line, which is the 200-day moving average. I just keep those on there because they're obviously widely watched. Interesting, that would mean potentially a golden cross, so a bullish signal. And we did get that move higher, breaking through that Fibonacci level that I've cited many times actually in our daily commentary, 65.49, that's 61.8 fib level there. So we did get a high through that, but we haven't sustained that, and you could just see now quite a strong sell-off today. So that sort of bullish signal really hasn't lasted very long. We're getting back towards that 50-day moving average. That's at 64.72. If I just pull it back then to say a shorter time frame, just referencing that question, then yeah, we haven't had the 50-day move through or the 200-day move through the 50-day either. So they are separate. So that doesn't help, I'm afraid. But as for the RBA, well, they're expected to continue lowering rates. Money markets pricing in a very high probability that they'll lower rates by 25 basis points to 3.6%. Just as a reminder, the bank did cut rates by 25 basis points to 3.85% at its last meeting in May. That was widely expected, and it basically stated that inflation continues to moderate. The outlook remains uncertain, and that maintaining low and stable inflation is the priority. Of course, inflation risks were more balanced, but they noted that uncertainty in the world economy has increased over the past 3 months, and volatility, of course, rose sharply. They did also release their quarterly statement on monetary policy during the last meeting, and that saw the bank trim domestic inflation forecast and slightly raise its unemployment view. Governor Bullock, she said that, well, during the press conference, the RBA is prepared to take further rate actions if required. And there was a discussion between a 50 basis point cut and a 25 basis point cut. Just for your guide, recent data points, well, weighted CPI, that softened in May to 2.1%. Versus the expected 2.3, while other key releases actually also support the case for a rate cut. Unemployment change, that saw a surprise contraction in May of negative, so a contraction of 2,500 versus an expected 22,000 positive gain, and the previous was 89,000. And that also came after GDP in Q1 disappointed at 0.2% versus the expected 0.4%, previously 0.6%. And real GDP also, well, that moved lower from, well, sorry, was below its expected 1.5%, printed at 1.3%. So that's the RBA really. Post-meeting language probably expected to be fairly non-committal, just for your guide. And I know one big investment bank, Westpac, I think they've suggested perhaps the RBA could be even a little sort of grudging about the decision to cut. So just bear that in mind as well. Aussie dollar, you can see being moved obviously by external events. With the Aussie and the Kiwi selling off quite sharply, really quite underperforming actually the other major currencies, just looking at those. The yen is third weakest, with then the Swissy and the CAD pretty similar, and then the Euro and Sterling sort of outperforming their majors, or their peers, sorry. But obviously losing against the dollar, which is gaining ground now, up 0.4%. So the Aussie, yeah, you've got the 50-day moving average at 64.72. Then below that, you've got the halfway point of this move lower from that high in October. That halfway point is at 64.27, and then just below that, the black line, the 200-day moving average, that's at 64.13. So some support, decent support around those levels. And then obviously you've got that recent high and resistance, it looked like, because it looked as though we could be breaking higher, and then we've rolled over. So that resistance just below spot 66. That's for the RBA and the Aussie dollar. Moving on then to the RBNZ. They're likely to keep rates unchanged, actually. So I'm just checking out the market here. Yeah, RBNZ likely to keep rates unchanged. Around a 25% chance, though, of a possible 25 basis point cut. Again, at this prior meeting, well, the RBNZ delivered its sixth straight cut at that meeting in May, widely expected, and the bank noted that inflation is within the target bands. Core inflation is declining, and it's well placed to respond to domestic and international developments. The RBNZ, they did lower its overnight cash rate OCR projections for the entire forecast horizon, actually, and they also cut its June 2026 CPI view at that meeting. The key message really was they've come a long way and are well placed to respond to developments, but are not sort of pre-programmed on moves going forward. That kind of suggests the central bank will likely pause in the immediate term then. And we have had comments from Assistant Governor Ashley Silk, who suggested a lack of urgency to continue cutting rates. She noted that rates are in the 2.5 to 3.5 neutral band, with the impact of past cuts yet to flow through amid a strong export sector. Ultimately, the bank, I guess, will look to data to decide when and if they cut from here. Key data releases kind of support the pause, actually. Q1 GDP top forecasts 0.8% versus an expected 0.7%. So bottom line, really, easing bias probably expected to remain, but very little forward guidance as the bank monitors domestic as well as, of course, external events. As for the Kiwi, you can just see similar pattern to the Aussie, broke higher, got above 61, actually 61.19, that high from Tuesday last week, but then we rolled over again. We just tapped that blue line, which is the 50-day moving average. That's at 59.84. And then again, similarly, we've got fib levels in here. Halfway point is at 59.32 of this decline from that September high from last year down to the low in April. Yeah, so halfway point of 59.31. And then a 61.8 actually, which could offer resistance again. Looks like it has around here. That's at 60.36. Just briefly, otherwise, I said it's a quiet week for the dollar on the calendar at least. Maybe some focus on the FOMC minutes from the June meeting. If you remember, the Fed kept rates unchanged at 4.25% to 4.5% for the fourth straight meeting. That's after delivering 100 basis points of cuts before that. Basically, the minutes should show how different policymakers are thinking about the risks to the economic outlook and to the Fed's dual mandate, of course, of maximum employment and price stability. Could be a little stale as well, of course, because we've had the non-farm payroll report since then, and of course everybody's focused on the tariffs and any announcements. You can just see this is the DXY chart, so this is the dollar against 6 of its major trading partners. As I always say, by far the biggest weighting is the euro in this index, around 56, 57%. So just bear that in mind. If you mirrored this chart, it would look a little bit like euro dollar. And you could just see, declining trend, of course, bear channel, if you like, series of lower lows, lower highs, and we're just sort of up, sort of touching this downward trend line. So interesting whether we can break above that. So resistance, yeah, probably the blue line again, the 50-day moving average, which has capped the resistance on a number of occasions this year already. So that's a 99.03, so some way from that. And if we just pull this back, actually, just want to show you, we've still got in this strong cycle swing low really from July 2023. That's at 99.57. But also, if I go a long way back, I've got this dotted line in here, which is this upward trend line from these lows, significant lows from 2011. And if I just put it back to the daily, you can just see we just sort of, that's acted as support, interestingly. So whether that continues will be definitely something we're watching. But yes, resistance sort of maybe these swing lows from April. That's at 97.92, so just below 98, and then that 50-day moving average, 99.03. We certainly need to get above that, and probably 99.57 to arrest, if you like, to stop this medium-term downtrend. Just quickly, we've got time, I think, just to look at cable as well. So sterling against the dollar. We do have UK GDP out this week, Thursday, I think. Growth expected to print 0.1% after the 0.3% contraction in April. Comes surprisingly after a strong start to the year in the UK. That's primarily due to tariff front loading, basically. And more recently, we've had soft retail sales amid a cooler labour market, basically sitting with still kind of elevated inflation in the UK. For cable, kind of defies, or sterling certainly sort of defies a lot of doomsters that are talking about the UK economy. Of course, we've had issues with the finance secretary, the Treasury Secretary, if you like, the Chancellor Reeves, and that sort of blip last week, that strong sell-off. But then we have held that previous high that I've still got in here, 136.31, and we're just oscillating around that. If we do lose that, then potentially we move out of this bull channel. And again, you've got the 50-day moving average capped a couple of times. Downside, that's at 134.73 now. And then I've got this swing high in here from September 2024. That's at 134.34. Otherwise, that high from last week, just for your guide, where was that? 137.88. So just below 138 in cable. I think interesting really is euro sterling, because that has moved higher. So the sterling has weakened quite substantially. You can see this upward trend since lows in the end of May there. So we've got a high from last week at 86.69. That was on the sort of Chancellor Reeves PM Starmer potential issue, but that was sort of batted back by Starmer, really giving his full back into Reeves in the end. But interesting, yeah, euro sterling for us, whether we get anywhere near this spike high, that's at 87.38. But otherwise, yeah, we're sort of around this minor fib level at 86.20 at the moment. Okay, I don't see any other questions. If you do have some, please do answer them along the way. Actually, while we've got a bit of time, just Canada jobs we do get on Friday as well. Just briefly, unemployment forecast to print around 7%. As the Bank of Canada recently stated, the job market has weakened. Bottom line, of course, is a trade deal is crucial for the outlook for the Canadian economy. And the bank is predicted, the Bank of Canada that is, to cut rates again in the autumn. Dollar CAD, that has been moving low, you can see, but just found support around 136 a couple of times now. We've just bounced off that today. If we just pull this back, you've got, support. Well, the low from June is 135, where 135.38, and then you've got this long-term low 134.20. Otherwise, you've got a minor fib level, 137.13, and then again the blue line is the 50-day moving average. That's at 137.56. Okay, a few levels there for you on CAD. I think I will wrap it up there. Lots going on, of course, lots of uncertainty, lots of headlines. We call it headline havoc, really. So take care out there, because it will be quite tricky, and things could change abruptly, I guess, with different announcements. So just be careful of that, I would say. We will be here for sure. Please do follow us on social media. And also, I always say we do print a daily commentary put out on the website after the US close. That has a look at the dollar, US stock markets, and also a look at the day ahead in slightly more detail if things are coming up, and then a chart of the day as well. Okay, take care, and we will speak to you same time next week.